The stock market always has a few surprises in store, as any investor in 2020 would attest. Now that you're venturing into the stock market with your hard-earned money, you want to make sure that you're investing in the right stocks. Welcome to the Silver Leo. Today, we'll be talking about the best stocks to buy in 2021. If you like our videos, then don't forget to subscribe and hit the bell icon too. Now let's get to the real deal. The best stocks to buy in 2021. The coronavirus pandemic is a horrible thing. Over 120 million people around the world have gotten sick, with nearly 2.7 million people losing their lives. There's no downplaying the seriousness of this illness. However, even the darkest cloud has a silver lining. E-commerce companies have become prime beneficiaries of the crisis. For months, consumers were told to stay at home, only leaving the confines of their homes in search of absolute necessities. While there were already growing numbers of consumers shopping online, travel restrictions and lockdowns led to a tidal wave of consumers who shifted from brick-and-mortar shopping to shopping on the web. Naturally, Amazon.com, one of the most successful e-commerce websites in the world, seemed likely to benefit greatly from this trend, and benefit it has. Since March 2020, the company's stock price has climbed from around $1,800 per share to more than $3,000 per share. And that's even after a recent correction in tech stocks. With this kind of growth, the e-commerce pioneer has not only become one of the largest companies in the world, but one of the strongest growth stocks in the market today. As a result of the growth, the stock trades with a pretty high valuation, with a price-to-earnings ratio of around 74, compared to the e-commerce average of around 55. All in all, with e-commerce dominance at a time when more and more people are shopping online, Amazon.com stock is one to watch closely. Upwork is a tech play that's focused on connecting contractors and those in need of contract work in the gig economy. Those who need articles written, graphics created, websites built, and a long list of other services will find talented experts in these crafts on the company's website. Of course, Upwork needs to make money in the process, and it makes plenty. In order to use the platform, freelancers must agree to the following fee schedule. Freelancers pay 20% of their billings to the company for the first $500 paid by a new customer. From $500 to $10,000 in billings of the customer, the platform charges a fee equal to 10% of billings. Finally, for all billings of a single customer with total billings of $10,000 or more, the company takes a 5% cut. Prior to the coronavirus, the gig economy was already taking off. Consumers who have dreamed of working from home finally had a way to do so. Then, as the world shut down, the gig economy boomed. The bottom line here is simple. Upwork has seen tremendous growth already, and considering the flourishing of the gig economy and the trend toward remote work, that growth is likely to continue. As a result, the stock is one to pay close attention to. Staying on the tech trend, Apple is next on the list. With a market cap of more than $2 trillion, the tech giant is one of the largest companies in the world. And like the stocks mentioned already, it has become a household name. As you likely know, Apple is the creator of the iPhone, iPad, and Mac computers, with the iPhone representing the vast majority of the company's revenue. The stock had a strong start to the year, but gains tapered off in late January and again in late February, bringing the stock down to what many believe is a discount. There's a good reason for this belief. In big tech, there are few growth stories that are quite as strong as Apple's, especially in the fiscal first quarter of 2021. Revenue grew across all categories. iPhone revenues came in at $65.6 billion. They not only beat analyst expectations of $60.33 billion, but also showed incredible growth over the $55.96 billion reported in the first quarter of 2021. With the iPhone representing the lion's share of the company's revenue, this is a very exciting metric. iPad revenue came in at $8.44 billion, climbing from $6.729 billion in the first quarter of 2020. On top of the compelling growth seen in two of the most important segments of Apple, the wearables and home accessories arm of the company saw revenue climb from $10.01 billion in the first quarter of 2020 to $12.97 billion in the same quarter this year. Finally, the company's high-margin services business generated revenue of $15.76 billion, up dramatically from $12.7 billion 1 year ago. However, like other big tech names on this list, the high valuation associated with the stock is offset by the strong growth seen in revenue and earnings, growth that many believe will continue for the foreseeable future. The Walt Disney Company is yet another household name on the list. Even if you've never been to Disneyland, you likely grew up watching Mickey Mouse or another Disney character bouncing around on your television screen. Moreover, if you're like most millennials who have cut the cable cord and chosen to stream entertainment, you've at least heard about Disney Plus. When it comes to investing in the company, there are two big reasons you may want to consider diving in. The Walt Disney Company felt quite a bit of pain as a result of the COVID-19 pandemic. Without consumers wanting to travel, its theme parks, hotels, and cruise lines have been struggling. The company's theme parks and travel attractions are open, but only at a 35% capacity. However, vaccines are being widely given, and growth in infections has slowed significantly, suggesting that COVID-19 won't be delaying consumers' travel plans much longer. Around the world, people dream about going to Walt Disney theme parks, and considering the state of the COVID-19 pandemic, demand is likely to boom ahead when capacity restrictions are relaxed. This will naturally lead to a significant rebound. One of the major drivers in Disney's recent stock growth has to do with its activities in the streaming entertainment space, which it has knocked out of the park. Launched in November 2019, Disney Plus had 94.9 million subscribers as of February 2021, up from 86.8 million in December 2020 and 60.5 million in early August. All in all, Disney has struggled from time to time, but you can never count the stock out. As was the case with the COVID-19 pandemic, the company has a history of pivoting and making changes that are best for its growth and its investors. That's not likely to change. The Walt Disney Company has plenty of potential for dramatic growth ahead. And there you have it, folks. We hope that you enjoyed our video, and if you did, please leave a like and subscribe if you haven't done already. Your suggestions are very important to us, so do post them in the comment section.